An unfunded trust is just an expensive piece of paper. I see this every single month. Families who paid $5,000 or more to create a trust plan, but still walk into probate as if they never had it to begin with. And that's because nobody told them about the second step. I'm going to fix that today. But first, what does funding actually mean? The trust itself is just rules. It's directives as to what's supposed to happen after you're gone. But those rules, the trust itself, only applies to the assets that are in the trust, either ones that you transferred into the name of the trust during your lifetime or made payable or transferable on death through a beneficiary designation that names the trust after you pass away. Until those two things happen, the trust doesn't actually control anything. Understanding how you are going to fund your trust is crucial. Our attorneys are ready to guide you every step of the way. Simply click the link in the description below. When we're talking about funding trust, we're often talking about really three different asset classes. First is real estate. That's controlled by what's called a deed. The ownership of the real estate itself is often something that you acquired through the issuance and recording of a deed when you bought it. The deed, if it says your name, is in your name, not in your trust. So transferring or funding real estate into a trust is to actually create a new deed from you to your trust and record it in the county where your real estate's located. If the home isn't in the trust, then it often makes its way to the trust after you've passed away in the worst possible way, through the will. And when the will is the primary driver of real estate asset transfer, it's through probate. So we created a trust, but didn't fund it. The will funds it through probate. The second is bank accounts and brokerage accounts, accounts that are not IRAs or 401ks. These could be checking, savings, or money market at the bank, could be a brokerage account at Schwab or Fidelity or Vanguard or something similar. For these types of accounts, we actually own them now, and we can transfer the title on those accounts in the same way we do with real estate, except no deed is required. We just need to go directly to the financial institution, either the bank or the financial services company, to retitle the name on those accounts to be the name of your trust. So if it's an individual trust, it's the name of the trust. If it is a family trust, we go from joint to joint trust. Brokerage accounts can actually be easier because we don't have to set up new accounts in the same way we would with bank accounts. The FDIC regulations don't allow us to just change the name on an account, so we're often required to set up new accounts. With brokerage accounts, we can just change the title on the brokerage and everything stays the same. We don't need to liquidate the securities or move cash one way or the other. With bank accounts, we often have to open new accounts. Not as big of a deal for savings and money market because they're not operational accounts, but for checkings, it can be a little bit more intensive. New checkbook, new debit card, new direct deposits and auto drafts that we otherwise had to set up the first time around. Some people like to avoid this by adding what's called a payable on death beneficiary to our checking accounts to make sure that it stays in our name, but will pay on death to our trust after we're gone. Now, retirement accounts and life insurance are different. These are accounts that only transfer by beneficiary designation. They are individually owned during our lifetime, and so they are not ever joint. We don't ever change the title on these accounts. We just beneficiary designate them to a named beneficiary. Sometimes that's to our spouse on primary, to our trust on secondary. If we're not married, then it's to our trust on primary. But this is very dependent on your goals and your beneficiaries and the best way for them to get the benefit themselves. There are tax implications for IRAs and 401ks, so we want to make sure that we're doing it the right way. For retirement accounts, we also have to abide by what's called the Secure Act, and most beneficiaries under the Secure Act fall under what's called the 10-year withdrawal rule. That means that your beneficiary has until the end of the 10th year following your death to take the entire balance out of your retirement account. That is distinct and separate from bank accounts, real estate, and brokerage accounts. You have to pay special attention to those rules. If you're worried about unintended consequences, our team is here to help you. Make trust planning easy by clicking the link below. For life insurance, we're using beneficiary designations just like IRAs and 401ks, except the tax consequence and the rules are vastly different. We still pay to a beneficiary, but what they get is tax-free cash in the form of a check made out to their name. If it's to a trust, then the check is made out to the trustee. The trustee uses that for whatever the trust requires, but there isn't a tax obligation on the proceeds of the life insurance like there is for retirement accounts. If you own a business, then that business is probably in an LLC or a corporation. And those are LLC membership interest or corporate stock that you own in your own name. We fund a trust with these different entity ownership models or mechanisms by transferring them into the name of the trust. So the member for the LLC becomes the trust itself. The shareholder on the stock becomes the trust itself. Sometimes if we have a professional entity or something that is filing for an S Corp status with the IRS, we'll instead make those interests transfer on death to the trust and keep them in your name during your lifetime. So we can keep the benefit of the individual ownership that you already have, but eliminate the probate reality of owning it in your own name by allowing it to transfer on death. Now, generally, each person, all of our clients are going to have very specific funding instructions, a checklist, if you will, of things that need to be transferred or updated after the trust is in place. Typically, that takes between 2 and 6 weeks if we're operating without delay. The Cary estate planning team includes what's called a done with you funding meeting. So not just is the instruction itself catered to your trust and your assets, but we also meet with you with an attorney to lead you through how to include your trust on your assets, but allow you to log into your own accounts with our assistance to make sure it's done right without any sort of privacy issues. If you already have a trust and you're not really sure if it's funded, really easy way to figure it out. Pull the deed to your house and see what it says. If it's still in your name, probably not a fully funded trust. If it's in the name of your trust, it's a really good indicator. You can click the link below to start the conversation. Protecting your family requires more than just standard documents. Schedule your consultation with our team today.